So imagine this. You've done everything right, like everything. You spent years paying off credit card debt. You never missed a car payment. You built your credit score up to something that honestly makes you a little proud when you check it. 750, maybe 780. You saved up a solid down payment. You got your debt-to-income ratio exactly where the experts say it should be. You walk into that bank or that lender's office feeling prepared, feeling for maybe the first time in your adult financial life like you have actual leverage, like you're the one with something they want. And then you get the offer, and something feels off. The interest rate is higher than what you saw advertised. The fees are a little harder to explain, and when you ask questions, the answers come back wrapped in so much jargon that you can't quite tell if you're being confused on purpose or if you're just not smart enough to understand. Now, imagine your neighbor, similar income, similar credit score, maybe even a slightly messier financial history, walks into the same process and walks out with a better rate, less in fees, a monthly payment that's meaningfully lower than yours. The only visible difference between the two of you, the color of your skin. That's not a hypothetical. That's a documented, studied, reported, and repeatedly confirmed reality for Black borrowers in America. And honestly, my name is Emmy, and I spend way too much time thinking about money, systemic financial structures, and why people who do everything right still somehow end up on the losing end of systems that were never quite designed with them in mind. That's basically what this channel is. A long, ongoing conversation about why money works differently depending on who you are, where you come from, and sometimes what you look like. Today, we're going deep on something that I think a lot of people know exists in a vague, uncomfortable way, but don't actually understand in specifics. And specifics matter here, because when you understand exactly how this works, the mechanisms, the data, the paper trail, it stops feeling like a conspiracy theory and starts feeling like what it actually is, a system producing predictable, measurable, and ongoing harm. And more importantly, you start to understand what you can actually do about it. So let's get into it. Part 1. The numbers don't lie, even when the industry wishes they would. Let's just start with the data, because I think that's where a lot of people need to begin before their brain will let them engage with the bigger picture. In 2021, the Consumer Financial Protection Bureau released data showing that Black borrowers were denied mortgage applications at nearly twice the rate of white borrowers, not slightly more. Twice. And this was after controlling for income, so we're not talking about a gap explained away by the wealth disparity, at least not entirely. We're talking about something that persists even when you hold the financial variables more or less constant. A landmark analysis by The Markup, this investigative journalism outlet that does incredible data work honestly, looked at over 2 million conventional mortgage applications across the country. What they found was stark. Even when you controlled for income, loan amount, neighborhood, and other financial factors, Black applicants were 80% more likely to be denied than white applicants. Latino applicants, 40% more likely to be denied. Native American applicants, 70% more likely. And it's not just denials, it's the terms on the loans that do go through. Studies have consistently shown that Black borrowers who are approved pay higher interest rates on average, sometimes only by fractions of a percentage point, which sounds small until you do the math. On a $300,000 mortgage, an interest rate that's just 0.5% higher means you're paying roughly $30,000 more over the life of a 30-year loan. $30,000! That's a year of a kid's college tuition. That's a car. That's an emergency fund that could change your family's financial stability for years. And here's the thing that really gets me about this. These aren't outlier stories. These aren't the result of a few bad actors scattered around the industry. This is a pattern that shows up in the data again and again across different lenders, different cities, different economic climates. The pattern is the system. Part 2. Understanding redlining, because the past is actually not past.
Okay, so to understand why this is happening now, you have to understand what happened before. And I know some people hear the word redlining and their eyes glaze over a little, because it sounds like a history lesson. But stay with me, because this is actually the foundation of everything. In the 1930s, the federal government, specifically the Homeowners Loan Corporation, created these literal maps of American cities. They color-coded neighborhoods by what they considered investment risk. Green was the best, safest investment, red was the worst, too risky to lend in. And the neighborhoods coded red, the ones where banks were essentially told through federal policy not to give mortgage loans, were overwhelmingly black neighborhoods, hence the term redlining. This wasn't a coincidence. The HOLC explicitly factored in the racial composition of neighborhoods when making these assessments. The presence of black residents was literally listed as a risk factor in official government documents. So federal policy was directly saying black neighborhood equals financial risk equals no loans. Now, the Fair Housing Act of 1968 made this officially illegal, and here's where I want to be really honest with you, because I think this is where a lot of people's mental model breaks down. They think, okay, it was illegal after 1968, so the damage is sort of contained to before that point. But that's not how generational wealth works. That's not how compounding works. Think about it this way. A house that was worth $30,000 in 1940 in a white neighborhood might be worth $800,000 today. That's not just inflation, that's 70 years of appreciation, of equity being extracted and reinvested, of wealth being passed down through inheritance, through help with a down payment, through a parent co-signing a loan for a kid who otherwise wouldn't qualify. That's what compounding wealth looks like across generations. The families who were locked out of that process, who couldn't buy in those appreciating neighborhoods, who couldn't build equity, who couldn't pass housing wealth to their kids, they're not starting from the same place today. And then when they try to buy now, they often have smaller down payments because there wasn't generational wealth to draw from. And smaller down payments mean higher loan-to-value ratios, which means technically higher risk, which means higher rates, which is how a policy that ended in 1968 is still producing its effects in 2024. The past is not past, it's math.
Part 3, the algorithmic problem, or how discrimination learned to wear a suit. Here's where it gets a little more complicated and also more relevant to right now, because some people will say, and they're not entirely wrong, that modern lending is much more automated and algorithm-driven than it used to be. Loan officers don't just make gut decisions anymore. There are credit scores, there are automated underwriting systems, there are standardized criteria. So shouldn't that make things more fair? Not quite. The issue is what those algorithms are trained on. If you build an algorithm to assess creditworthiness and you trained it on decades of historical lending data that was itself produced by a discriminatory system, you're not getting a neutral tool. You're getting a very efficient machine for reproducing old biases at scale. Here's a specific example. Credit scores, which are the backbone of mortgage underwriting, heavily weight things like credit history length and credit mix. These might sound like neutral financial factors, but who has long credit history? People whose families were in the formal banking system for generations. Who has diverse credit? Mortgages, car loans, credit cards going back decades? Again, people whose families were connected to those systems. People who grew up in households that used cash, check cashing services, or community lending, often because they were excluded from or underserved by traditional banks, don't have that same paper trail. So even if they're financially responsible, even if they've never missed a payment on anything they've actually had, their score reflects an absence of data rather than an absence of responsibility, and that absence gets penalized. There's actually research on this. A 2021 study from the Urban Institute found that millions of credit-worthy borrowers, disproportionately people of color, are either unscorable or receive scores that underestimate their actual credit-worthiness. The system doesn't see them clearly, and the gap in visibility produces a gap in opportunity. And then there's the neighborhood factor.
Some lenders still, even if not explicitly by race, factor in the neighborhood characteristics of the property being purchased when setting terms. And because of the legacy of redlining, neighborhood correlates heavily with race. So you can have a technically race-neutral criterion that produces racially disparate outcomes because of what neighborhood represents historically. This is what scholars call disparate impact. The policy doesn't say treat Black people differently. The policy says consider neighborhood investment risk or weight credit history heavily, but the outcome is racially disparate, and it's protected by the plausible deniability of neutral language. Part 5. The Appraisal Gap. A house being worth less because of who lives in it. Okay, I want to spend some real time on this one because it's one of the most viscerally unfair parts of the whole system, and also one of the most concrete and documentable. Home appraisals determine what a house is worth, and that valuation affects everything, whether a loan gets approved, how much you can borrow, what you can sell for. Appraisers are supposed to be objective, professional assessors of market value, and when they work well, they are. But research has uncovered a consistent and troubling pattern. Homes in Black neighborhoods and homes owned by Black families are systematically undervalued than comparable homes in or owned by white families. A 2021 study by Freddie Mac found that homes in Black and Latino census tracts were significantly more likely to receive appraisals that came in below the contract price, meaning the appraiser valued the home lower than what the buyer and seller had agreed to pay. This can kill a sale or force the buyer to make up the difference in cash. Either way, the buyer loses. And then there's the case studies that made national news, families discovering that their home's appraised value jumped significantly when they removed family photos and had a white friend greet the appraiser. That's not anecdote, that's a documented phenomenon called whitewashing appraisals, and it has led to federal investigations and lawsuits. The Brookings Institution found that homes in Black-majority neighborhoods are undervalued by an average of $48,000 compared to homes in white neighborhoods with otherwise similar characteristics. That $48,000 gap is wealth that doesn't exist for the Black homeowner. It's equity they can't borrow against. It's inheritance they can't pass down. It's compounding in reverse. And the cruelty of this is that the homeowner did everything right. They saved, they bought, they maintained their property. The system just refuses to reflect its value accurately. Part 6. What Fintech promised and what it delivered. So, naturally, when financial technology started disrupting traditional lending, a lot of people, myself included honestly, had some optimism. Like if you remove the human loan officer from the equation, if you make it all algorithm-based and data-driven, maybe you remove some of the bias. Maybe Fintech is the great equalizer. It's complicated. On one hand, some research does show that Fintech lenders approve Black applicants at higher rates than traditional banks in certain segments. That's real. The automation does reduce some of the interpersonal discretion where bias can sneak in. But on the other hand, and this is the part that keeps me up at night a little bit, the algorithms these Fintech companies use are often even less transparent than traditional underwriting. With a bank, you at least know roughly what they're looking at. With some Fintech lenders, the models are proprietary black boxes that no one fully understands. And if the bias is baked into the model, you have no way to see it, challenge it, or prove it in court. There's also the pattern of where Fintech lending is and isn't available. High-cost, high-risk Fintech loan products often penetrate communities of color more aggressively, while the genuinely better products get marketed toward demographics who already had access to prime lending. So Fintech can end up replicating the two-tier system, just with a sleeker interface and a mobile app. The promise of technology solving structural racism in lending is real, but incomplete. Technology is only as fair as the humans who design it and the data they feed it. And right now, we're still in the middle of figuring that out. Part 7. The wealth gap this creates and why it's a national emergency. I want to zoom out for a second and talk about what this all adds up to, because I think sometimes when we're in the weeds of interest rates and appraisal gaps, we lose sight of the macro picture. The racial wealth gap in America is staggering. According to Federal Reserve data, the typical white family has roughly 8 times the wealth of the typical black family. 8 times. And home equity is the primary vehicle through which American families build wealth. Not stocks, not savings accounts. Home equity. For most families, their house is their biggest asset. It's their retirement. It's their kids' college fund. It's the thing they leave behind. When black families are denied mortgages at higher rates, when they pay more for the loans they do get, when their homes are appraised lower, when the neighborhoods they're steered towards appreciate less, every single one of those mechanisms is a wealth leak. Money that should be building equity is going to interest. Value that should be accumulating is being undercounted. Wealth that should be passing to the next generation simply doesn't exist. And this isn't just a black community problem, even though it falls hardest there. An economy where a significant portion of its population is systematically unable to build wealth through the primary wealth-building mechanism is an economy running on less than its full potential. The cost of the racial wealth gap in lost GDP, in economic underperformance, in the downstream costs of poverty has been estimated in the trillions. This is everyone's problem. It just doesn't feel that way to everyone equally.
Okay, I want to be careful here because I don't want to end up in the trap of putting all the burden of a systemic problem on individuals. That's not fair, and it's not entirely effective. Systemic problems need systemic solutions, but I also believe deeply that knowledge is leverage, and there are real, concrete things you can do to protect yourself as much as possible while you're operating inside this system. Shop aggressively. This is probably the single highest impact individual action. Research consistently shows that black borrowers shop around for mortgage rates at lower rates than white borrowers. The reasons for this are understandable. The process can feel hostile and exhausting, and if you've been treated poorly once, you might not want to go through it again. But getting multiple quotes is how you find the outlier lender who gives you a fair deal, and it's how you create leverage. 3 to 5 quotes minimum. Use online lenders alongside traditional ones to get a range. A half-point difference in rates across quotes is $100 a month on some loan amounts. That's real money. Get pre-approved, not just pre-qualified. Pre-qualification is a rough estimate. Pre-approval means they've actually run your credit and looked at your documents. It carries more weight, and it makes the process more concrete. It's harder for a loan officer to move the goalposts on you once there's actual paper in front of both of you. Know your credit score intimately. Don't just know the number, know what's on your report. Dispute anything inaccurate, and there are inaccuracies more often than you'd think. Understand what's driving your score and what would move it. If you're 6 months out from wanting to buy, a credit audit is one of the best things you can spend time on. Document everything. If you're in a loan process and something feels off, rates that changed without explanation, fees that appeared out of nowhere, reasons for denial that seem vague, write them down. Dates, names, what was said. You may never need this, but if you do, you'll be very glad you have it. And if you believe you've been discriminated against, the Consumer Financial Protection Bureau and HUD both have complaint and investigation processes that are free to use. Consider a HUD-approved housing counselor. These are free or low-cost advisors who specialize in helping buyers navigate the mortgage process. They can help you understand your options, review loan offers, and flag anything that looks off. They're an underused resource, and they're particularly valuable for first-time buyers who are navigating this process without family members who've done it before. Ask specifically about every fee. Origination fees, processing fees, underwriting fees. Some of these are negotiable, and some are padding. Lenders are required to give you a loan estimate, and you should go through it line by line. Ask what each fee is for. Ask if it can be reduced. The discomfort of asking is worth it. And if you're in a position to advocate beyond your own situation, talking to your local elected officials about enforcement of fair lending laws, supporting organizations doing litigation and advocacy work in this space, even just having informed conversations that spread this knowledge, that matters too. So here's where we've been.
We started with a number on a credit report, a number that's supposed to be objective, supposed to level the playing field, and we followed the thread all the way back through algorithmic bias, through the appraisal gap, through the long shadow of redlining, through the sales rooms where subprime loans got pushed on people who deserved better, through the fintech promises that turned out to be more complicated than advertised. And what we found isn't a conspiracy. It doesn't require anyone sitting in a room twisting their mustache and saying, "How do we keep Black families from building wealth?" It's something in some ways more insidious than that, a system that produces racially disparate outcomes through layers of individually deniable mechanisms, each one pointing to some technical justification, none of them quite catching the full weight of what they're participating in. But I want to end on something that's not despair, because I genuinely don't think the answer is despair. The answer is clarity, and I hope that's a little of what today gave you, because when you understand how something actually works, you can't be manipulated by it as easily. You know what questions to ask, you know what to document, you know what to demand, you know what to look for in a lender and what to walk away from. Home ownership is one of the most powerful wealth-building tools available to ordinary people in this country, and there are real, documented efforts by real bad actors and real indifferent systems to make that tool less accessible and more expensive for Black Americans. Knowing that is the beginning of being able to fight back. The mortgage system in America has a lot to answer for, and the families it's failed deserve more than vague promises and slow reform. They deserve advocates, they deserve policy change, and they deserve the chance to build something that lasts, the same chance that other Americans have been quietly compounding for generations. Your credit score doesn't just represent your financial past, it represents your hope for a financial future, and you deserve a system that sees that clearly. Thanks for watching, and if something in this hit home, share it, because the more people understand this, the harder it is to keep it invisible.